You're looking at a scarred, muddy strip mine. But with the right planning, this is actually the foundation for a high-end eco-resort. Over the last century, heavy industry and extraction powered global growth. As energy markets and manufacturing shifted, they left behind millions of acres of abandoned mines, factories, and quarries. Meanwhile, developers today face a severe squeeze. Rising material costs and a shrinking supply of prime real estate make traditional ground-up construction wildly expensive. These abandoned industrial sites offer a massive competitive advantage. Researchers and builders categorize them as novel ecosystems, ready-made habitats for high-value development. Treating these wastelands as toxic liabilities leaves money on the table. They are actually lucrative blank slates in the modern real estate market. Take reclaimed surface mines. In mountainous regions where steep, uneven terrain normally makes large-scale development impossible, mountaintop removal has left behind hundreds of flat, contiguous acres. These legacy sites come with built-in infrastructure, heavy-duty access roads, high-capacity power lines, and industrial water access are already in place, wiping out a massive chunk of initial site prep costs. The same logic applies to urban environments. Historic textile mills and auto plants offer high ceilings, structural steel, and exposed brick, architectural character that draws high-paying travelers seeking an authentic experience. This chart shows the cost difference. By reusing an existing foundation and structural envelope, developers can acquire and convert these assets at a 40 to 60% discount compared to building entirely from scratch. The sheer scale and existing infrastructure of these properties mathematically rewrite the economics of a hospitality project long before the first guest checks in. But non-traditional real estate requires a highly specialized operational playbook. You can't drop a standard hotel layout into a factory and expect it to work. The first approach is the heritage boutique model. Disused municipal buildings and mills often have highly irregular room footprints. By treating these odd shapes as premium, story-driven design elements, operators command higher average daily rates to offset the lower total room count. The flex living model solves the problem of obsolete suburban office buildings with deep floor plates. Guest suites are placed along the windowed perimeter, converting the dark interior core into shared amenities. With automated check-in, operational labor drops below 20% of gross revenue. The third strategy is the experiential eco-resort. For former surface mines and waterfronts, developers deploy low-impact modular cabins or glamping pods. This phased approach generates immediate cash flow without requiring massive upfront capital for permanent buildings. Across all three blueprints, profitability comes directly from exploiting the unique architectural quirks of the asset rather than fighting them. Even with a perfect operational plan, none of this happens if a developer can't finance the severe environmental risks of buying a brownfield. This chart shows how developers build a multi-layered capital stack to absorb those risks. The foundation relies on non-repayable public grants, like EPA and abandoned mineland funds, which pay for soil remediation and heavy earth moving, keeping it entirely off the developer's balance sheet. The second layer is monetized tax equity. Programs like historic tax credits subsidize rehabilitation, while the Inflation Reduction Act grants an automatic 20% bonus for placing clean energy infrastructure on verified brownfields. The final layer uses specialized private debt and patient capital, like Opportunity Zone equity. By holding the investment for 10 years in these distressed tracts, all capital growth becomes entirely tax-free. Layering these specific subsidies completely flips the financial equation. It transforms a toxic site that traditional banks won't touch into an aggressively de-risked, high-yield asset. So who actually benefits from this specialized financial engineering, aside from the developers? First, it transitions local labor markets. As the extraction industry winds down, these new resorts create demand for hospitality management, culinary arts, and outdoor guiding, keeping workers employed in their home regions. Municipalities gain a massive expansion to their tax base. The new lodging, sales, and commercial property taxes directly fund local schools and essential city services. That influx of visitors sets off a secondary ripple effect. Travelers leave the resorts to spend money at nearby craft breweries, restaurants, and retail shops, pushing new capital directly into Main Street. Reusing these assets anchors a town's recovery. The combination of new tax revenue, job variety, and local spending creates a level of stability that extraction alone rarely provided. Finally, to protect lenders and future owners, developers wrap these completed sites in environmental impairment liability insurance. This secures a no further action letter from the state, legally erasing the site's legacy liabilities. We have millions of acres of obsolete real estate. These sites are dynamic canvases for adaptive reuse, capable of housing the next generation of leisure and industry. Transforming our industrial past builds the infrastructure for long-term economic resilience.